Hey everyone, thanks for joining. Thanks for jumping on here. We're right at 2 o'clock, so I'm just going to give everyone a minute to filter in here. Just for little housekeeping items, if anyone has kind of questions throughout the webinar, please feel free to drop them in the Q&A bucket there. I'll keep an eye out and work through them as we're going through the webinar. And just as a note, obviously you're all here, but if you have to leave early or anything, I will be putting up a post with this webinar, so you can get the video after. Second, I got someone having trouble logging in here. All right. Well, I'm gonna go ahead and get started here. Um, so today we're going to be talking about an introduction to overlay strategies. And we're going to get into a little bit about what these are overall, kind of how they fit into long-term portfolios, and ultimately kind of how we look at them at Harvested Financial and specifically with the tape report, and how some of those strategies you can use the tools, the software to help analyze them and ultimately help implement them also. So I have a presentation here that I'm going to walk through. But again, like I said, questions, comments, please feel free to throw them in the Q&A section, and I will get to them. I'm happy to take them as we go, or I'll also I've got some time reserved at the end here. Just another housekeeping item. I will plan to kind of keep this to somewhere in the 35 to 40-minute range. I plan on doing a lot of these, and so my topics are specifically intended to be short and sweet. I know no one wants to sit on a webinar all day, also. So without further ado, we will get into some overlay strategies. So before that, though, that's why I put this slide as number two. I do have to remind everyone that while I am a financial advisor, I'm not necessarily your financial advisor. And so if you have any questions about the terms and conditions here, I suggest you go and visit my website. Nothing here is considered financial or investment advice. That only comes within the terms of a contract. And consult a professional for any questions you might have, legal, tax, financial, otherwise. So, like I said, check out my website, terms and conditions, for the full details. So, here's the problem that we as long-term investment have, or long-term investors have with the markets. And that is that volatility is both a feature and a bug in the markets. It is a feature because on the upside, we get positive volatility, and that's what creates positive returns. On the downside, of course, we have negative aspects of volatility, and that's the bug part. Drawdowns, anytime that the market is in a kind of steady kind of retracement, that's not the volatility we love. We don't like seeing an asset that we, have invested for a long period be worth a lot, then worth less. And, it's confusing in terms of long-term pricing. So volatility, while it does generate the returns, the kind of like I say here, the cost of the equity risk premium is a concentrated exposure to passive beta. So you're along for the ride when you're long, a passive investment structure. And, these are some of the most popular investments out there, whether you're using a Vanguard vehicle like VOO, something like SPY, or any form of mutual fund or target date fund, or there's a lot of just long beta in the markets, and that equity risk premium, which has been significant over the years. We're talking about on average somewhere between 4 and 6% above the risk-free rate of returns provided by bonds. Equities have compounded very successfully, but we all know what happened in March of 2020 or April of 2025, or frankly, even a little bit of the dip that we had earlier this year. So volatility is everywhere in the markets, and that's kind of one of the least palatable parts about being long equities in long-term investing. So here I also say that edge is the difference between process versus outcomes. And as we'll kind of discuss with a lot of these overlay strategies, process is a really important part of the whole dynamic. Unfortunately, we can't necessarily control the outcomes, and there's randomness in there. So the edge comes from the difference between those two, finding a repeatable process and finding something that is going to survive, multiple outcomes. Since we're talking about overlays today, I want to define very specifically what an overlay is. And an options overlay is something that complements a specific underlying equity position. It's where we trade an option against a stock position that we're holding. That could be buying protective puts or a protective put spread, like we see here. That could be something like selling a covered call. That could be some combination of those two. That could be short a put and long a call. But regardless of the structure, an overlay for our purposes here is something that is aligned with an underlying stock position that is used to increase or decrease the risk profile. Both of these examples here, the protective put spread and the covered call, those are risk decreasing overlays. But as we'll discuss a little bit further along here, there are ways to increase the risk of your underlying position by using an overlay component. And yes, they can be built with single options like a covered call. They can be spreads. They can be in the same month. They can be in different months. So there are a lot of different ways to define an overlay, but generally we consider something that alters the risk profile of that underlying stock. I'll double click on the difference here in that what an overlay is and isn't, in that an overlay is distinct from an allocation. And so there are lots of different ways to trade options. There are, cash secured puts that you can sell that have nothing to do with a specific underlying, though or I shouldn't say they don't necessarily correlate to a stock position. Or there are butterflies or condors that you can trade. There are lots of different ways that you can trade options that aren't overlay like. There are systematic ways to do that. There are, conservative and aggressive condor strategies you can use to capture and generate kind of orthogonal returns to the markets. But those aren't necessarily what we're considering for these purposes overlays. So those are strategies that work independently of an underlying position, but would benefit the overall sort of allocation. So these are, when thinking about building a portfolio, you might have a sleeve of option strategies that are allocated, but they don't necessarily alter the risk profile of a specific stock or index or ETF. They're more designed to work as an independent strategy that is to some degree correlated or uncorrelated to the whole portfolio. Whereas overlays are very much wrappers. They're using options to alter that risk profile, that return structure, or that income structure from an underlying position. So here we have a chart of the SPX over the last 3 years. And I kind of doodled on here when I think it's interesting to use an overlay. And you can see it's a lot of the time that in a lot of these overlay strategies, particularly the ones that I've built, they're meant to be long-term structures. They're meant to be wrappers around this position, not just for today, although that is a potential use case. The short-term hedge as an overlay is a use case, but market timing is really difficult. And whether you're using options or whether you're kind of trading on your own, trying to time the market, we all know is just a notoriously difficult task. There's the great stat that something like 95% of fund managers don't beat the S&P 500 because, well, timing and picking stocks is a really difficult job. So The idea of overlays, and particularly the systematic overlays that we deploy at Harvested, is that they're useful most of the time. So we have the yellow regions here when the market is kind of trending up in low vol periods, and then the red bubbles when the market's crashing. So overlays are useful when we're trending up. Specific types are going to work better in different market conditions. But then something like the hedged equity strategy that we'll get into is particularly beneficial in dampening those drawdowns. So overlays are not necessarily meant to be a timing feature so much as a systematic application of risk adjustment positions. So the first class of overlay strategy that I want to talk about today is our hedged equity strategy. So as a preview, we're going to talk about two major strategies. The first is a dampener, and the second is an accelerator. And so the hedged equity strategy is our version of a put spread collar. In the tape, we call it HedgeRoll. And both of those components, both the hedging and the rolling component, are important. And the purpose of this strategy is to protect and to participate. So that protection comes from the idea that we're looking to limit the downside exposure within a certain buffer range. So if I want to get technical about that options position, a put spread collar, a collar is typically defined as a short call long put in that it collars the returns of that equity. Whereas using a put spread, instead of just buying an outright put, you buy a spread, and that allows you to sell a slightly higher call if you're looking to do this on a cash neutral basis. So a standard application would be to buy a put spread at a given kind of buffer zone that we're targeting the range under which we want to offset that downside, that drawdown. So we want to set our buffer zone, and then the cost of that put spread we fund by selling an upside call. So we protect using that downside buffering put spread, and we participate between the current spot price and wherever we sold that call above the market. So typically this is done on a cash neutral basis, like I said, and we want to set that put spread. If you set that put spread exactly at the money, well, you're not really going to be able to sell much of an out of the money call. We do need to take a little bit of risk with this position. So, maybe we set that initial buy leg of the put spread just below the market and then sell a put further below that. And then the debit we pay there is offset by a credit from the short call. Again, that participation gives us several percentage points over the duration of the structure. And we're allowed to participate to the extent that the market drifts up. If it finishes anywhere kind of within that zone, you look just like a regular equity position. You smoothen out on the downside, and then you're capped on the upside. So the goal here is to deliver less volatile returns and in exchange for giving up a little bit of the upside because of course the market moves around in fits and turns. That volatility is a bug. Sometimes that comes to the upside, and that's kind of the trade-off that you're making with the hedged equity strategy. That's actually a good point. That's the first time I've mentioned the word trade-off today. Trade-offs are what options are all about. And so it's important to remember that when we're overlaying an option strategy on an underlying position, that the every options, decision we make is going to be a trade-off. Either we're going to be accepting less upside for less downside, more protection for slightly less participation in the hedged equity strategy, or sometimes we need to take more risk to generate more returns. So nothing's free. There is no free lunch out there. That options are really about risk transfer, specifically for these overlay strategies. And we want to think about using the option structure not to generate, money out of nowhere, but to use the option structure to alter the risk profile of that underlying. So when we think about that hedge roll, I sort of got into there a little bit with some of those strike selections. There are kind of four key components to parameterizing that and defining that. And I'll get into this a little bit more later when I demo some of the stuff on the tape, but testing all those different parameters is really important. Not because it's about finding the optimal parameter or there is no optimal combination of this, setup that's going to necessarily generate the greatest return. there is, but that doesn't necessarily mean it will in the future. It's so much as understanding the kind of path that different parameters will lead you down. What does it look like to have, for example, a greater buffer zone width? So that buffer zone is where is our long put and where is our short put? Because the tighter that zone is, the kind of less dampening you'll get. But that allows, that'll create a cheaper put spread, allowing you to sell a higher out of the money, further out of the money call. So determining that buffer zone width. The more buffer zone you want, the lower your participation level is going to be. Same question with this buffer starting point. Where do I set that? Am I setting that just out of the money? Am I setting it 10% out of the money? And that's really a risk tolerance question that to the extent that you have a longer horizon, generally we want to start that buffer a little bit lower and let the market wiggle a little bit more so that we can get that upside. To the extent that you want to be more conservative with the investment, that this is some either money that you'll need, in the near term, or whether, you're just an overall less aggressive, less risk tolerant investor, we want to move that start or that buffer starting point up. We want to extend the width as a corollary there, that the wider the width, the closer it is, the less risky it's going to be. Another big component of parameterizing that hedge roll is thinking about what target expiration do we want to use. So the most common way, and as many of you are probably familiar with, JP Morgan runs a very large options fund that does kind of vanilla flavor of this. And they typically will set that target expiration as quarterly. I also think that quarterly makes sense for a couple different reasons. Generally the question and the trade-off here with expiration setting is that the longer expiration you set, it cuts two ways. It'll A, allow the, ups and downs of the market to quote unquote sort themselves out over time. But the trade-off is that if the market is on a strong uptrend, you've missed out on that, on significant percentages of the gain. So resetting more frequently allows you to capture more of that dynamism of the market, but that's not necessarily always a good thing because if you're resetting more often, you're kind of locking in loss, locking in a gain, and constantly adjusting that. So it adds some complexity, it adds some more activity, of course, but it has the effect of kind of cutting you up and locking in, from a lot of active trading. So that 90-day period, that every 3 months quarterly frequency generally seems to work pretty well as a target expiration. And just to give kind of context, if we're looking at a 5%, 20% out of the money put spread for that period, so giving up 5% of downside, protected below that down to a 20% drawdown, you're generally going to get, depending on what the option surface looks like, somewhere between 5.5 and 7% of upside possibility. So, a 20% drawdown in a quarter would be pretty big, but more than 7% sometimes does happen. So, just to give an idea of sort of where those risk, numbers come in at 90 days. The fourth element here in terms of parameterizing a hedge roll is, and this is a unique feature that we have over at Harvested and at the tape, is the ability to tranche the position across several different months. So rather than having all your option structure sitting at a 3 month period and then expiring all at once, we layer that out across 3 different months within that. So every month you'd have a third of your position expiring. And so that's a nice feature for some of that rebalance timing, right? That you get the benefit of adjusting every month to some degree, but you're not moving the whole position around. So if the market does, and when it does, I should say, have those kind of fits and starts, the tranching definitely mitigates some of that. Um, and kind of another layer that I don't necessarily have here, but I'll point out that we have in the tape is the ability to define some of those parameters, some of these parameters, whether it's the width or the starting point, based on the volatility regime. So not all markets are the same. During periods of low volatility, we might want to adjust that structure differently than in periods of higher volatility. And so by adjusting those and not necessarily using fixed percentages or normalizing those to the different vol regimes, we can kind of apply a different, more tactical rebalance that is kind of regime aware. So the second strategy they want to introduce is very much the flip side of that hedge roll strategy, and where hedge roll is designed to buffer the returns, SkewPreme is designed to accelerate those returns. And so we take the underlying equity. This typically works best on indices. So whether that's SPX, SPY, QQQ, something like that generally is a good proving ground for the SkewPreme strategy. And that name comes from the skew premium that you are collecting on this strategy. And where HedgeRoll was about protection and participation, here SkewPreme, the stock replacement strategy, is very much about the risk and the reward, that we're replacing a portion of our stock position with an option structure. So if you were going to, say, have 100 shares of an index or an ETF, rather than having all 100 shares, just going in and clicking buy, quantity 100, we would say, let's only allocate 70 shares to holding underlying equity, and we're going to create synthetically those remaining 30 shares with an option structure. And you can create, 70/30, 80/20, 90/10, 80/120. There are, as many different strikes as there are different options positions to put on. And there are over 1 million strikes. So the stock replacement here, by using options to replace some of that stock, we are capturing a little bit of that skew premium that's embedded and getting not only the delta exposure, so not only the directional exposure that that option structure gives us, but we're also benefiting from the skew curve and the fact that put options are priced higher than call options in implied volatility terms. So to double click really quickly on what that means, the relationship within a month, within a given expiration, the relationship between the different strikes, where we have strike on the x-axis and implied volatility on the y-axis, the relationship there is typically downward sloping. So lower strikes typically have higher implied volatility. Strikes that are below the current stock price have higher volatility than strikes that are above the stock price. And the reason for that are many, but briefly, there's the hedging demand. So, this point that natural order flow wants to buy downside protection. The risk you're taking here is that you're selling options that risk averse investors want to buy. So the risk averse investors want to buy protective puts to cover their standard long stock position. So that natural supply and demand is going to somewhat elevate the downside put options. And conversely, they're going to sell the upside call, maybe to fund that, maybe is just another type of overlay. But that covered call is going to depress the call options. And the protective put raises the put options. So if we flip that on its head and say, I want to get my short put and long call, I want to use those to create long deltas, right? A long call is going to have positive delta. It's going to go up in value as the stock price goes up. But a short put is also going to have long deltas because it's going to go uh, down in value, which means you'll make money as the stock price goes up. So by selling a put option and buying a call option as a stock replacement, we are going to receive a net credit from that. Now, there are stocks, we can look at, sometimes it's in a Tesla or an Nvidia or a GME would be famously extreme, where the call options are trading above the put options. And part of the reason we like doing this in indices is because that skew is fairly persistent. And so we get that skew premium by taking on that additional risk. Now, that additional risk doesn't come out of nowhere. Their volatility does tend higher as we go down. We've noticed this naturally if you're an investor in the markets, that things get a lot choppier as we're trending downwards. So taking that extra risk to the downside is rewarded by that extra credit that we get to put on that short put long call trade. Um, so the other interesting point here is that there's not only this behavioral reason why investors like that downside, but there's also a lot of structural mandate behind that. And so the reason I like this strategy and the reason I like hedge roll is because there really are structural reasons why these risk reward trade-offs happening. I'm not giving away any particular alpha here, that there isn't necessarily a secret that I've uncovered in the markets. As much as I wish I could say that, mostly what this is about risk transfer and using the embedded risks and pricings of risks in the market to take on higher or lower risks as an investor and to put on something that is more suitable for the portfolio that we're looking to build. So as we think about parameterizing the SkewPreme strategy, we want to think about that delta level. We want to think about where we set those or how much of our portfolio we want to replace with stock. Is it 20%? Maybe we'd sell a 10 delta put and buy a 10 delta call. 30%, 15 and 15. And so we generally keep those deltas even. But of course, as we increase that delta number, it's going to be a choppier experience. We're getting closer to the money with our option structure. There might be more assignment and exercise risk, whereas the further out of the money, well, there might be a greater premium in terms of implied vol terms. In a dollar terms, we're going to be getting a little less there. So typically that 10, 15, maybe 20 delta at the risky end is a sweet spot. That also tends to be a place where there's a lot of hedging flow for kind of second order Greek reasons. The delta changes with respect to volatility are most interesting at that 15 delta level. So there's another sort of like theoretical embedded reason why that we choose that level there. So we set our delta level, then we initially need to set kind of an expiration for this. And unlike the hedge roll, this is a little bit more of an actively traded strategy. In fact, this is a strategy that will rebalance weekly. It'll reset monthly. So that target expiration is where we're going to go out something like 30 days. We're going to let that structure decay over the course of the week. And then within that same expiration, we're just going to adjust the deltas because there's time decay that happens. There's delta movement that happens. There might be volatility shifts that adjust those deltas. That's one of the catches with options is that things move around. And some of the premium comes from being able to manage the things that move around. So we're rebalancing the strategy weekly. We're rolling it within the expiration. And then ultimately, number three is that roll timing. When do we want to reset it back to our original target date? So we might set it out a month, adjust it every week for 3 weeks, and then move it back out another month. So we're always sort of sitting on that same part of the decay curve of the term structure of options. The other hedge that might happen is number four, the hedge parameter. When you're selling downside puts, when you're collecting that skew premium, a part of that risk is the higher volatility and the elevator down that markets will take. And so, to the extent that the option position gets so far out of whack that your deltas move so much, maybe implied volatility goes up, giving that put a higher delta. It's going further towards that put, so it's getting a higher delta. Any and all of those reasons might require an adjustment with the underlying stock position. So that's another feature. And something at Harvested Financial, if you work with us to implement this strategy, we have all of these components automated. That we work with a bot partner that essentially has all of the logic here baked in, and it will automatically hedge based on those underlying conditions. Another feature of the tape, if you wouldn't prefer to move assets, is we have automated notifications when any of those hedges need to take place. So this is definitely a little bit more of an actively managed strategy, but as we'll see in a minute, it does generate slightly better returns than the S&P 500, than a standard index strategy. So the pitfalls of the overlay, a lot of items on this screen. And that's because anytime you're working with options, there are a lot of things to consider. And there are a lot of moving parts at any given time. There's a lot of timing and decisions to be made. But just to highlight a couple of these, and a lot of this problems that we're trying to solve over at Harvested Financial and the tape report is some of these pitfalls. So the first is understanding the return streams. And next up, I'll show you some of the tools. I'll give you a little preview of some of the tools that we have to help understand those return streams. Because one of the things I believe most strongly in options markets is that no strategy is going to work for you if you don't understand what you're going to get out of it. That could be covered calls, that could be cash secured puts, that could be condors, that could be a hedge roll strategy. Any of those strategies aren't the right strategy for you, or I should say, none of those strategies are the right strategy for you if you don't understand what the ups and downs are going to look like, and more importantly, what they're going to feel like. So, understanding return streams, super important here. We've got to think about the base equity of return. We've got to think about what the options are doing. Are there any dividends that come from that? All of these different components, how do they play together? How do they look over time? So that's where we lean on a lot of back tests to help describe that. Timing, rebalance timing is an important thing. We certainly don't want to catch ourselves buying high and selling low like this. Good demonstration of why we like to tranche things out over different months, but also staying on top of things. A lot of options expire on a Friday afternoon. Is that something that you want to be managing at 3:35 or 3:55 Eastern on a Friday afternoon? So making sure that you're adjusting all those rebalances when they're expected to rebalance, because the rigor and the structure is what you've been testing for, and so the implementation has to match that. The effort of doing all that, the implementation effort, we need to be scanning the market. We need to be tracking different moves. We need to send in our order tickets. We need to manage the trades. We need to reconcile that we have the right positions. There's the tax reporting on the other side of all of this. So generally, there's the question of, is this return structure making sense still? Am I getting out of this what I wanted? So implementing these is definitely a heavy lift. The, you know, if volatility is both a bug and feature of the equity markets, I would say expiration is the same thing for options. It's both a bug and a feature. It's great. It's why theta, it's why time decay exists, but it means those positions are always going away. Strike and expiration selection. So items number 4 and 5 here, thinking about what call do I pick? Some of those volatility adjustments come into play here. Do I really want to sell a 4% out of the money call in a highly volatile environment? Well, I might want to give myself more room to run. Or do I want to sell it 90 days out now? Hey, things are suggesting that maybe a shorter duration might work. Understanding all those different variables is a big part of wrapping your head around what's going on in an overlay strategy. So as I've been hinting, these are some core strategies over at the tape report, and kind of the difference we have there is the idea of moving along this trend of identifying the signal, identifying the timing and volatility conditions, and monitoring what's happening in the market, looking at those conditions, providing some context, having historical analysis to provide that context, and understanding whether this is something that's to be expected or whether this is kind of an out of bounds type structure that, is a never before seen. We've seen everything in markets. But then bringing that all through into action. So implementing that trading, what strike selection should I be thinking about, and how to incorporate this overall into my trading, my portfolio. That's what we're here to solve at the tape, is we want to make overlay strategies as simple as possible so that people understand what's going on and what they can expect going into it, and they can follow along easily to actively trade these strategies with, the best success possible. So I'd be remiss not to remind everyone on here that if they're interested in any of the products over at the tape, to through the end of the month, we have coupon brand new tape that'll be 20% off for lifetime. So definitely check that out, brand new tape. If you're interested in either upgrading to a new report, if you're interested in joining our client program, or if you're brand new to the tape in general and just looking to get started with one of our analyst or investor packages, the coupon is good through the end of this month. We got 4 more days on that. So just head over to the tape.report and you'll find all the details there. And that is where I will take us now to take a look at some of the items that are in the tape report. And some of the back tests give you kind of a brief review of what those tools look like and how we kind of take all that theory that we just talked about and what that really looks like in action. But before we do that, I just wanted to see if anyone has any questions. Nope. Okay, we can head over there. So let me share my screen again. And so all of these and more strategies exist over in our strategy laboratory. So the strategy laboratory is part of our investor package, and this is the package that's designed for as the name suggests, investors that are managing long-term strategies for their portfolio. So today we talked about a little bit about SkewPreme and the HedgeRoll strategies. But as you can see, there are a number of different strategies going on here. There will be future webinars. You're all on the list and you will be notified about those coming up. So please stay tuned. We'll do deep dives into all of these. But first, I will pull up HedgeRoll. And kind of the way the whole flow works is for clients, you'll get a recommendation here of what strategies either you have engaged or what strategies are recommended to you based on your risk profile. So these are, just some dummy strategies that I have going on. Um, but if you're interested in back testing a new strategy, and I can't emphasize how important this is, that if you're thinking about getting into a hedged equity strategy or a SkewPreme strategy, run a couple back tests. Decide just what parameter is going to make sense for you. But even if you don't change any of the parameters, get an idea about what they are going to look like, how they're going to behave over time. So all those different parameters we talked about, you can set a bunch of different start and end dates. You can focus on the last 3 years, 5 years, last 15 years, capital base, set all the different buffer zones, target expirations, all kinds of good stuff here. So once you kind of enter those in, it'll, submit the back test. That generally takes somewhere between 2 and 3 minutes, 5 minutes on the outer side. I continue to work on sort of performance improvements there. But we will take a look at some of the saved back tests that I have here for hedge rolls. So this is a standard SPY hedge roll. So I've got those 5%, 20% parameters, 90 DTE going back 10 years. So spoiler alert, hedge roll doesn't do as well as the buy and hold strategy. But that's not the point. We know we're trading away upside for having that buffer on the downside. And so you can see just visually here that that lower strategy line, the green line, is a lot smoother. And there are higher lows and there are lower highs that come with that. Number wise, what we'll see here is we have an annualized return with the hedge roll strategy over the last 10 years of 9.7%. Really not bad. 15% on the other hand for the buy and hold S&P. And that's with dividend reinvestment, by the way. So we assume fractional shares, sort of the most aggressive compounding within SPY. So that's an annualized return of 15%. So we're roughly two-thirds, just less, slightly less than two-thirds of the return. But the real winner comes here because of these max drawdown numbers and volatility numbers. That we're looking at max drawdowns of a little less than half and volatility of well less than half. So 8% volatility compared to 17% volatility. So while those returns aren't quite as good, the volatility is significantly less, which gives this strategy a better Sharpe ratio than just the buy and hold of the S&P. Now, there's no ignoring the fact that that gross return is, more than double, but that's not what the hedge roll strategy is for. And I think, a lot of us can accept that the last 10 years look have been very surprising for markets. 15% CAGR for the S&P 500 with dividends reinvested. That's at the upper bounds of what we've looked at over the last 100 years. So the market's been on quite a rip recently. And so particularly if you have any sort of long-term inclinations about, potential, slower periods or significant drawdowns, HedgeRoll's a good opportunity, and it really preserves that capital base for something that allows you to participate a little bit in the markets without worrying that all of a sudden you're going to wake up one day and your account's down 35% or 34%. Moving over to SkewPreme, we have here, sort of our standard 15 delta put, 15 delta call, 25 days out. Our rollback level is about 9 days to expiration. Um, and we go back 10 years in this strategy. So I ran that a little bit earlier today, and it'll just pull up my saved back tests here. Let's look at the details. The total return on this is going to be about 346%. And that annualizes to about 16 and 0.1%. So that compares to the same, these are in the same period, 320 with the SPY and 15.4%. So over the same period, we do about 70 basis points more per year than the S&P 500 and end up with about 25% higher returns at the end. The drawdowns are almost identical. So negative 34%, negative 34.8 versus 34.1, or sorry, 34.9 versus 34.1. And the volatility at 17.3 versus 17.7. So we have just marginally higher volatility with about 70 basis points more of return per year. So the idea, this should have the history. I uh, I just added that feature before, so um, and there we go. There's the benchmark in here. So we can see that it does outperform the benchmark, and more so recently, actually. So it's actually in the last 5 years that the structure of the market has sort of started to separate here. I'll attribute that to slightly higher volatility recently. By recently, I mean over, 3, 4, 5 year period, and some of that steeper skew than we might have seen in the first part of this period. So, you know, not financial advice. That definitely is a structural thing that I think there are good arguments why we could continue to see that. That I think everything from the pace of trading to the accessibility of markets to the speed of the news cycle, all of that I think is going to contribute to more short-term volatility and a persistent higher skew structure, which does benefit something like SkewPreme in that you're selling that uh, structure. So, if we compare the drawdowns, they're slightly more, like I said, slightly higher volatility, but we do get a marginally better Sharp, and that compounds, over a 10-year period to be something meaningful. Almost an extra year's worth of returns. You get the 11th year for free, I guess. That's definitely not financial advice. But the, main reason why you get the additional premium is that, you're being compensated for some of that downside risk, and some of that downside risk does require hedging it out, the active management of selling shares if the market really does go down. That allows us to keep pace with those max drawdown numbers, but when times are good, it slightly more pays for it through that embedded premium there. So I've only scratched the surface on what you can kind of do with the backtest analyzer. Uh, if you run a bunch of tests, you find something that's interesting, you find something that you like, the main value add of the tape is this ability to subscribe to this strategy. So, we might go in and we rename it for whatever we want. We'd put in either a number of shares or an initial capital base that we want to do. And what this will do is, as it suggests, provide notifications to when to roll. If you're a client, it'll tell you what strikes to buy. It'll tell you, which positions to close, which positions to open. If there are any hedges that come up, all of those will be delivered via SMS, via email, however you want. And then, to the extent that you're interested in being a client moving assets over, that's something that we automate also using bots internally. So you wouldn't even have to make the trades. But the main value proposition of the tape is that there is a lot going on with overlay strategies. We've seen that with a hedge roll strategy, with a hedged equity strategy, and we've seen that with the accelerating strategy, the SkewPreme strategy. But staying on top of that's difficult. We're here to help. And that is the digital advisory that is the tape report. So taking advantage of the power of the options market right here, taking advantage of all the potential for risk transfer. Markets have never been more liquid. They've never been tighter. So strategies like these, actively managed strategies, increasingly get cheaper. They get cheaper to implement, and we're able to execute these at near fair value. So we don't even have to worry about slippage. All we're doing is focusing on getting that risk profile and adapting the risk profile of an option strategy is exactly what overlays are about. So with that, I again want to open it up to any questions that people might have with regards to this strategy, or these strategies, I should say, or perhaps the tape in general. Yes, pricing, of course. So I'd encourage you to go to the tape.report to get the full breakdown. If you go under membership, you'll find the three different packages we have. We have our analyst package that is all about our edge screeners. That's our opportunity capture suite of tools. And there will be future webinars on those. So everything from trading expensive puts, we have some blue chip overwrite strategies. We have some put selling strategies. We have all kinds of fun stuff that goes on in the analyst package. And then we have the investor package, which is where the strategy laboratory sits and all of those different overlay and sort of risk transfer strategies. So the analyst package is $79 a month, and the investor package is $149 a month. That, of course, includes everything that's an analyst and a bunch of other tools. One of the most fun ones is our stock intel feature, which I plan on doing a webinar on soon. That is a AI-powered analytical tool that writes research reports based on the proprietary data that I have and the data analysis structures that I provide it, along with trusted news sources and providing kind of contextual fundamental information there. So a lot of fun stuff in Investor. And then the third part is the client overlay that is a $99 a month overlay. And that's where once you take a risk test, financial advisor, can provide true financial advice. What price, what stock, what strike, what expiration, all the details of exactly what and when to trade. So we have a bunch of different trading strategies within that, and all of the strategy laboratory trades will come with specific prices and whatnot. So there was a lot to cover, and I know I'm a couple minutes over, but I hope this was all informative for everyone today. I hope you can tell I really enjoy talking about this. And I'd love to keep talking to all of you more. So check out the tape report. Continue to please sign up for these webinars. For the current members, make sure you join our Slack channel. And for potential members, make sure you check that out. That's an awesome feature. We're growing the community there, looking to get engaging discussion about how to use these tools, how to think about these markets, and most importantly, use the tape report. So other than that, you know where to find me. You can use the feedback form on the website, or I'm always, happy to get emails, questions, comments, concerns. It's mark@harvestedfinancial.com. And like I mentioned at the beginning, there will be a recording of this webinar. So stay tuned for that. And happy trading, everyone. Enjoy the rest of your days.